Gary, moving on to thing number five. Again, we're calling this kind of our investor education thing that we've been at and working really closely with partners over at Learn Wall Street. Today, Gary, we're going to talk about if you're down in a stock that you like, when should you sell? Is the question that we're asking here today. Brings us to thing number five, Gary. Losses are sometimes okay.
Yeah, and figuring out how to limit losses and what your plan is really important. And here's why it's important. Raji Kabaz of Learn Wall Street points out some really basic math, but it's important math. Let's imagine for a minute you own a stock, the stock's trading at 100, and say it goes down by 50%. So now it's trading at 50. You've lost 50% of your money in that stock. For that stock to go back to what would be break even for you, back to where it was before, it has to rise not 50%. It has to rise 100%. To go from 100 to 50 is a 50% loss. To go from 50 to 100 is a 100% gain.
Hmm.
Once you've lost capital, it is increasingly more difficult to make that capital back up. Now, can it be done? Of course. I've been in the money management business for more than 3 decades, and believe me, we've all had bad stock picks, we've all had bad years, we've all had losses, and you work at it, you can make it up. But it's very important to plan ahead and figure out how you will handle losses, how you'll handle adversity. Now, there are a couple of ways that people do it. What some people do, and I don't do this, but what some people do is they use stop losses. And they say, okay, if the stock goes down 5%, I'm just going to sell it. If it goes down 10%, I'm going to sell it. Whatever that number is, they set that. And if they have a loss of that amount, they just sell the position and they say, look, I'm not prepared to lose more than 5% or 10% or whatever that number is for them in a name. And the good thing about that particular strategy is it means you're not going to get your head handed to you in one stock, in one name. And it's a way to ensure you don't take huge losses. And that can be a good thing. Here's the downside of that strategy. The downside of that strategy is there's a lot of volatility in the market, and stocks frequently move 5 or 10% for no reason at all. You wake up one morning and things are down, you wake up another morning, things are up, and sometimes there's just no reason. And so poor use of stock losses can just lead to lots and lots of 5 or 10% losses. And, this is why you need to consider your strategy. Now, what we do at Deep Knowledge Investing is we focus on potentially very high return stocks where there's some sort of misunderstanding of the investment opportunity, where the dominant narrative about a particular stock, a particular company is, in our opinion, incorrect. And the thing about those situations is the market can be incorrect for a long time. And so if we understand the reason a stock is down and we disagree with it and our investment thesis is still intact, I frequently will buy more of a stock when it's down. And when that's happened and we've been right in it, we end up making more money in this. And, one of the great examples we had in this with actually when Raji Kabaz and I were running Silver Arrow was a company called Digital Realty. There was a short story out on the company that was incorrect. The people who were advocating the short story didn't understand REIT accounting. REIT stands for Real Estate Investment Trust. Digital Realty was one of them. And the short sellers didn't understand REIT accounting, and they didn't understand the assets that the company owned. They thought they owned computer servers, which should be depreciated on a 3 to 5 year life. They really owned steel shelving that the servers were on, which have a useful life of hundreds of years. So we knew the short case was wrong, and we bought the stock and it went down. And everybody said the short seller's right. We knew we were right. We bought more of it. It went down more. People were celebrating the short seller and saying he was right. He wasn't right. We bought more. Guess what? That stock more than doubled off the low because it wasn't a fraud, because we did understand it. And so because we were willing to buy it down, because we were certain that we were right, and we were willing to take a long-term view, we ended up making more money in the name than had we just bought and hold. And had we just put stop losses in place, we would have lost more. Now, am I criticizing the stop loss people? No, not at all. If you're listening to this and you use stop losses and you use them successfully, and it fits your investment strategy and it fits your investment timing and your thesis, great. Good for you. We're not against you. We're not criticizing you. My point in all this is you need to know why you're invested in something, where you think you're right, where you think other people are wrong, what's making that stock move, and what your expected time frame is. And so because we understand all of this, we do the opposite of what the stop loss people do, and we've made more money because of it. Now, is that more dangerous? Yeah, and that's why we don't use leverage. Um, Frequently the people who are using stop losses, they're using leverage to get better returns. Now, am I being critical of that? No, it's not the strategy I prefer. But places like Millennium and Citadel have very successfully used that strategy with tens of billions of dollars. I'm not saying we're right and they're wrong. I'm saying to use these techniques successfully, you need to have a very clear understanding of what your investment thesis is, what your time frame is, and what your risk is. And if you understand all of that, you can put together a plan that will help you limit risk. And this is why it's so important. And so know your assets, know the stocks you're in. If you need help, reach out. This is what we do all day, every day.
Would you say, Gary, that on a general basis, when DKI might be selling a position at a loss, it is because that investment thesis has changed?
Yeah, that is exactly what happens. And you know what? I'll give you a great example, Rob. Um, we haven't had many losers at Deep Knowledge Investing. One was in a name where we made more than a double. In 2020 and 2021, we made more than double our money in HCA. I went back to it about a year ago and had the thesis that their margins would continue to improve, and we hit a quarter where the margins got a lot worse and the company missed. And I still think HCA is a great company, but I had a thesis. We got results that proved the thesis to be wrong. I sold the stock that day. I sold it instantly because the strategy that we use of buying more when you're down is when we know that we're right. Or no is a dangerous word. Let me rephrase that. When we have really good reason to believe that we're right, when we have a great deal of confidence that we're right and we understand what the market is missing. If my thesis in this situation was HCA margins will continue to improve, they've got pricing power, they're getting their expenses under control, and then we see a quarter where the opposite happens and the stock is down, I sold that same day and took the loss. And is it painful to take that loss? Yeah, of course it is. But if you're wrong, you're wrong. And it doesn't happen a lot around here, but you know, nobody gets it right all the time. I certainly don't. And, we just realized the loss immediately. And that's the right way to think about it. Again, you need to know what results would make you right, what results would make you wrong. And in the situations where results show that I'm wrong and my thesis is incorrect, we sell right away, regardless of what the stock has done.
Gary, thanks so much for your insights. As always, I know just personally, I gained so much out of these conversations. Hope all of you listening do as well. This was the Rising Price of Commodities edition of the Five Things. Just want to say, I know, Gary, you're very thankful a lot of times communicating with our listeners. I'd like to say the same as well. Thank you so much for listening to our show, subscribing to our content and information, and just supporting Deep Knowledge investing in general. We're really looking forward to continuous expansion of content, better content. We just recently put out a survey. If you haven't already seen that in our newsletter that we send out via email, let us know. We can get that out to you. We'd love to hear from you. Tell us what you like, what you dislike, so we can continue to improve the product and the service. But yeah, more than anything, coming from me as co-host of this show, thank you for being such a supportive group, and it's been so fun to watch this grow over the years, and we're really looking forward to more and more growth. Gary, any closing thoughts from you?
Rob, nothing more than what you just mentioned. For people who do want to check that out, either go to, deepknowledgeinvesting.com, click subscribe. We do have a free option. Put a note in there. Say, hey, send me the survey. I just
Yeah.
want you to know that both Rob and I have read and are reading and will read every single line on every single one of these surveys. We read everybody's comments, and we really do use that information to make sure that our programming is directed at what our viewers and readers and listeners and subscribers want and need. The one thing that doesn't change is the investment strategy, because that's how we make money. And if that's interesting to you, feel free to click the paid subscription option, and we'll do all we can to help you. But for those of you who are just watching and listening, thanks for spending your time with us. Thanks for liking and subscribing. We really appreciate it. And Rob, great to see you again. Glad to have you back in the host chair.
It's great. Thanks so much, Kerry.
All right. See everyone next week.